All right, today we're going deep on a really fascinating crypto trading strategy. It's a completely market neutral approach, which is cool in itself, but it's also a world of high speed bots, razor thin margins, and traders literally battling against market efficiency itself. Let's get right into it. For any trader, this is pretty much the holy grail, right? How do you make money when the market is just this chaotic mess of epic highs and gut wrenching lows? You'd think you'd need a crystal ball, but what if I told you there's a way to profit from the chaos itself? No predictions needed.
Well, the answer to that question might just be a strategy called triangular arbitrage. And what's so cool about it is that it honestly doesn't care if Bitcoin is soaring to the moon or crashing. All it cares about are these tiny, temporary imbalances in the market's own internal logic.
So, what is this thing exactly? At its core, triangular arbitrage is all about finding a loophole. Think of it as a super fast three-part trade that takes advantage of these tiny, fleeting price differences between three different crypto assets, all happening on the very same exchange to end up with more money than you started with. And look, let's not bury the lead here. Is this still a thing you can do in 2025? The short answer is yes, for sure. But, and this is a really big but, the game has completely changed. This is not for the casual player anymore. It is absolutely a game for pros who have serious capital, professional grade technology, and just incredible discipline. Okay, so how does this cycle actually spit out a profit? Let's break down the mechanics step by step. It might sound a little complex, but the logic behind it is actually surprisingly simple. So imagine you start with a stablecoin, let's say USDT. First, you buy some Bitcoin. Then, instantly, you trade that Bitcoin for Ethereum. And finally, you sell that Ethereum right back into USDT. And here's where the magic happens. If, after those three super quick trades, you have more USDT than when you started, well, that tiny surplus is your arbitrage profit. Now, the math might look pretty simple on the surface, and it is. You're just multiplying the exchange rates from your three trades. If that result is greater than 1, you've theoretically got a winner. But you have to pay very close attention to that last part of the formula, the fees. Fees are the silent killers of these trades, and we're about to see just how brutal they can be. And this number, this really puts the scale of this whole thing into perspective. This is not some obscure niche strategy people are trying out. On Binance, the world's biggest crypto exchange, a staggering 3% of all transactions are being executed by triangular arbitrage bots. It is a huge automated part of the market's very ecosystem. So this all sounds pretty great in theory. Find a loophole, print money. But the reality, especially now in 2025, is a story of just intense competition and profits that are shrinking by the day, which brings us to what we call the great margin squeeze. I mean, just look at this trend. A few years ago, it was pretty common to find gross opportunities of 2, 3, sometimes even 5%. That was huge. In 2024, that dropped off a cliff. And today, the typical opportunity you'll find is just a fraction of a percent. The market is getting smarter, it's getting faster, and it's getting way more efficient, squeezing out all that easy money. And this right here, this is the crucial point. Let's just walk through this example. Your bot flags what looks like a 0.35% opportunity on a $43,000 trade, so that's a potential 150 bucks. Awesome, right? But then reality hits. Trading fees instantly gobble up $86. Other network fees take another $40. Then slippage, that tiny price change that happens in the blink of an eye when you make the trade, shaves off 20 more. And just like that, your $150 windfall has completely evaporated, leaving you at just $4. This is exactly why capital is king in this game. I mean, if you're only making a few bucks per trade, trying to do this with less than $10,000 is, well, it's barely worth the effort. To turn this into a viable professional strategy, you really need to be playing in that $10,000 to $100,000 range. But the real game, where you can actually generate significant returns, that's being played by institutions with over $100,000 to deploy on every cycle. But it's not just about having deep pockets. It's also about speed. The hunt for these tiny profit margins has turned into a full-blown technological arms race, where the difference between making money and losing money is measured in fractions of a second. And this slide just illustrates the gap perfectly. A casual trader, maybe working from home on their regular internet, might have a latency of a few hundred milliseconds. The pros, on the other hand, are operating at under 1 millisecond. And they do this with something called co-located servers, which basically means they put their computers in the exact same data center as the exchange's servers. It's a massive, almost unbeatable advantage.
Yeah, this quote from the source material really says it all. We're not even talking about milliseconds anymore. The window of opportunity slams shut in microseconds. By the time a human trader could even process the information on their screen, let alone click a button, dozens of automated systems have already fought over and completely devoured the profit. So as traditional arbitrage gets more and more crowded, the smartest players are already looking to the next frontier, and that's decentralized finance, or DeFi. And in that world, there's a revolutionary new tool that is changing the game completely. So meet the flash loan. This is a concept that could only exist in DeFi. It lets you borrow millions of dollars with absolutely zero collateral, perform a whole series of trades, and then pay the loan back, all within the 12 to 15 seconds it takes to process one single blockchain transaction. It's wild. And if you can't pay it back, the entire transaction just fails, as if it never even happened. Now, what's really interesting is when you put these two strategies side by side. Traditional arbitrage, as we've seen, requires a lot of capital, and it happens on centralized exchanges. Flash loan arbitrage, on the other hand, requires zero capital, but it happens on decentralized exchanges. The technical barrier for building bots is already high, but for flash loans, it's on another level. You need to be able to write and deploy really sophisticated smart contracts. So, after all of that, after this deep dive, we come back to the really practical question. Should you, as a trader, be getting into this? Let's break down the final verdict based on who you are and what you're working with. Okay, if you're an institutional or professional trader, the path is clear, but it's incredibly demanding. You need, at a minimum, $100,000. You absolutely need that co-located server infrastructure to get your latency down. You can't rely on this strategy alone. It has to be part of a diversified portfolio of strategies, and your risk management has to be non-negotiable, with super strict limits on how much capital you risk on any single trade. Now, for retail traders with smaller capital, the message is pretty different. Honestly, this is not recommended as a primary strategy. A much better path might be something like funding rate arbitrage, which profits from the fees traders pay to keep futures positions open. The best way to approach triangular arbitrage is as an educational tool. Build a bot, use test money, and learn the skills. Your goal isn't to get rich, it's to build expertise that could maybe one day land you a job at a pro firm or help you make the leap into DeFi. And that leaves us with one final thought. The story of triangular arbitrage is really the story of markets becoming brutally, brutally efficient. As these kinds of easy loopholes get closed, the big question becomes, where does the real edge come from next? Is it going to be found in even faster technology, in revolutionary financial products like flash loans, or in entirely new, inefficient markets that haven't even been discovered yet? That right there is the billion-dollar question for the next generation of traders.